AI is taking over Google search, Google is dying, and ChatGPT is eating its lunch. Well, at least that's the narrative that has been painted around Google. You see, Alphabet, the parent company of Google, recently released its third quarter earnings, and after its earnings, the stock actually ran up nearly 9% before falling back down again. So what is it exactly that keeps getting investors spooked about Google? And despite being slow out the gate in the AI race, why Google could potentially be setting themselves up to take market share in 2025 and how that could affect their valuation. But as always, potential is a dangerous word, so let's dive in. Now, one of the common narratives around Google is that it's losing its dominance in the search marketplace. You see, this article by CNN basically tells us that although the word Google is synonymous with search, it is actually losing its dominance in that marketplace. Now, at the same time, the Wall Street Journal basically also released an article where it tells us that Google's grip on search is slipping. Other AI tech startups and things like TikTok is coming into the marketplace and eating its lunch. In fact, it showed this graph over here where it projected that Google's search marketplace is basically going to decline to below 50% for the first time in over a decade, or at least in the decade. And I want you to remember this graph because this is something that I'm going to be bringing up later. And then we also have this narrative about Google, being broken up for parts because it is this big, bad, monopolistic company that doesn't allow its competition to thrive. Now, immediately the problem I have with this, right, is that these two arguments are at polar opposite ends and they cannot coexist because they are a contradiction. Initially, people are saying, Google is losing its search dominance. They're allowing companies like Perplexity and TikTok, Facebook, Amazon, and things like that to come in and take market share. But at the same time, there are also this, big bad monopoly, that is killing off all the competition and is basically bad for the consumer. So which exactly is it? Because both of these things cannot be true at the same time. Either Google is a monopoly and they are not losing market share, or they are losing market share because of competition, which is healthy for the consumer, and it is not a monopoly. But when it comes to, breaking down Google into its individual business segments, I've actually covered this in a previous video that I will link over here for those of you who are interested to see how I actually value Google's individual business segments. But just by doing some back of the envelope math, we're basically able to understand that Google is actually more valuable when you break it up into each individual business segment. So as an investor, that's not too concerning. But I do think that the fact of the matter is that if you keep Google together, the profitable segments of its business allows it to offer, other services to the consumers at more affordable prices while still driving innovation. And more importantly, I think this only came up as I was recording because Trump won the election. This report from Reuters basically expects Trump to actually dial back some of the antitrust policy under the current administration. And I think, the current FTC director, Lisa Khan, has always been very pro, breaking up of all these big tech companies and things like that. And Trump, much less so. So in fact, I think in this report, he's actually quoted as saying that, if you do that, which means, if you break up the company, are you going to destroy the company? So he can actually see how that will affect the company and what can you do without breaking it up and make sure that it is more fair for the competition, which I think that is a more balanced approach to this. But don't trust what I say because we have to take a look at the numbers, you see, because management, analysts, and random people on YouTube can say whatever the heck they want. So it is important to take a look at the numbers and smash the like and subscribe button if you're enjoying the video so far. Thank you for your time and back to the video. Now, if you take a look at the financials in the third quarter of this year, Google's overall revenue basically came in at $88.3 billion, a 15% year-over-year increase. And if you break it down into the different segments, Google Services, which includes things like Google Cloud and other subscription businesses, grew 13% year over year, up to $76.5 billion, and Google Cloud grew by 34% to $11.4 billion. Now, their operating income was about $28.5 billion, which represented a 32% margin. Now, for those of you who might have watched my previous valuation video on Google, which I will link over here, you can actually hear me say that I expect margins to improve as they continue to scale Google Cloud. However, I did not expect the expansion of margin to be so quick. In that initial valuation, I basically only expected 32% margin in perhaps 2026 and beyond. So that is something I will actually have to factor into my new valuation model because although they have not yet fully scaled out Google Cloud, they are already at 32% margins. So as they continue to scale out Google Cloud, as Google Cloud becomes more profitable for the company, we can only expect margin to expand even further. Now, overall, they generated $26.3 billion in net income income, which is quite impressive considering that, with just 3 months of net income, they can actually buy up SoFi 3 times over. That's about $2.12 in terms of their EPS, and that represented 33.5% year-over-year growth. I think for me, when I look at it, I actually do think that people actually misunderstand Google search. Earlier on, we read that Google is actually losing market share in search, and how projected in 2025 they're going to go below a 50% market share for the first time in over a decade. And I think on the headline that actually sounds quite concerning. However, what people fail to realize is that the competition was always there. Companies like Facebook and Amazon were always there. Now, of course, newer companies like TikTok, even ChatGPT partnering with Microsoft Bing, definitely, all these new entrants definitely are expected to come into this market because this market is huge, it's ever expanding, and it's basically a very huge total addressable market. And so if you remember the graph earlier about Google's declining market share, what if I showed you this picture instead? Why does this picture show that Google's market share is actually over 90%? Is this picture from years ago? Actually, not really. If you take a look at the bottom corner of the picture, you notice that, this picture was actually done up, or at least this infographic was done up in June of last year. So just 1 year. So did Google lose over 50% of their market share in over a year? And so I'm going to quell your fears. No, this did not happen. Google did not lose over 50% of their market share in just 1 to 2 years. Because I think this is where I say consumers tend to misunderstand all these kind of statistics that are actually put out by all these news articles. You see, Google's dominance and where they really do have a stranglehold on is not the entire search market, but in one particular segment, which is known as the search engine market. Now, I hope to help us understand this from the perspective of a consumer and the different types of search. Now, imagine you're someone, deciding what kind of coffee to have every single day, whether or not you should, go for filter coffee or you should actually get a coffee machine. So basically what Google search does, it helps the consumer to better understand the product, better understand the pros and cons of each individual product. So basically, Google search tells me whether or not I should go for filter coffee, what's the pros and cons, or whether or not I should go for espresso and get a coffee machine, right? So basically, once I've decided, I'm going to get an espresso, I'm going to get a coffee machine, then I hop onto, platforms like Amazon and TikTok Shop and all of this, and I use this platform to actually search for the coffee machine that actually suits my needs. And so all of these are search, and all of these basically serve a different function in the buy cycle of a consumer. Because as a consumer, on things like Amazon and TikTok Shop, you can actually see the product in action before you buy it, which make it more suitable for that kind of search purposes. Now, these are not areas that Google actually has a very strong stranglehold over. You can actually argue that, perhaps in terms of YouTube, they do penetrate that area a little bit. But actually for me, I still see YouTube as more of, an information platform, providing information than actually driving a purchase. So in this area, I would say that they are far from being monopolistic. And where Google actually has an unfair advantage, or you can call it their moat, right? It's actually not in search, but in data. And I think that's what people don't understand about, Google's business. They think Google is a search business, but Google is actually a data business, and Google's whole business is actually about the data that they have. They use search basically as a means to monetize the data, and I'll touch on that later on as we cover their earnings. But basically, their whole business is centered around having the most data. And so as you can see, Google is not monopolistic, and it's definitely not dying, because if you take a look at this report over here, the entire search and advertising market is growing at about 8% CAGR, and as I'm going to show you later, Google search is growing faster than that. And so because this is a huge market, it is only natural that other competitors come in, and it's actually good for the economy, good for the consumer. So if you take a look at this picture over here, you can actually see that the growth in Google search revenue basically stagnated for a couple of quarters in the early part of 2022. The revenues in Google search basically stagnated coming out from the pandemic, right? Because people were finally allowed to leave their homes, and then, perhaps less people were on the internet and things like that. But over the last 5 quarters, you can see that they have managed to reaccelerate growth to the mid-teens %. And I think we can see a similar story here with YouTube, where growth was lumpy coming out from the pandemic, but it's reaccelerating as well. Now, the most exciting part of Google to me is this graph over here, which is their cloud services. If you take a look where the red line is, basically it shows you the growth in Google Cloud revenue, and the blue line basically shows you the operating profit. Now, you can see over the last couple of quarters, the operating profit actually inflected into the positive region, and basically, it's continued to grow from there, which is why we are at 17% margin now, I believe. Let's take a look over here. Google Cloud generated about $11.4 billion in revenue, which represented a 35% year-over-year growth, and operating profit for Google Cloud came in at 1.9 billion, yes, a 17% operating margin. So if you consider, Amazon's AWS having operating margins in the 30% range, then Google still has, a lot of room to expand its margins even further, which is why earlier on I was mentioning when I'm going to do my valuation again, I'm actually going to factor that in, because now they are only, let's consider it ramped up halfway. Their margins are already at 32%. So if they continue to ramp up fully, where Google Cloud is generating perhaps 30% margins, then their overall operating margin could be higher than the 32% number that they're showing right now. So looking ahead, I think one of the things that concern investors is basically summed up in this chart over here, right? If you take a look with me, the dark blue segment here basically represents the revenue brought in by Google Search, and you can see it actually makes up quite a large part of their revenue across the whole year. And the risk here definitely is that if US enters a recession in 2025, people will start to cut back on advertisements, and this portion of the revenue here will definitely be hit. And another thing that basically investors are concerned about, especially those who have positions in big tech companies, is that their amount of capex spend in terms of investing in AI infrastructure, it doesn't seem to really be slowing down. Because I think the worry here for the companies basically is that, if I stop my AI investments and, other competitors around me do it, will they start to gain an edge on me? But however, at the same time, the more they spend and not show, the considerable returns that justify the investment, then investors are at the same time also kind of, are a little bit skeptical of their investment in AI infrastructure. So for Google, they basically told us that they spent $13 billion in capex this quarter, and they expect to do the same thing in the fourth quarter. And they also guided for increase in spending in 2025. However, they say the increase will not be as drastic as we actually felt in 2024. So basically, I want to bring your attention to this Bloomberg article over here about Google integrating their AI into their search engine. Now, at this point in time, I think, at the start, a lot of people were worried about Google search losing its dominance, especially to things like ChatGPT, right? Where all these large language models, or the LLMs, basically started to popularize and come out. But as we have seen, over time, these LLMs have really become a commoditized product. And the real goal was actually in the data that was training the AI model. And that is why I said earlier, Google is not in the search business, but they're actually in the data business. And so as they integrated their AI function into Google Search, I think you can see more and more people start to adopt it, and I personally love it. And so basically for me, right, what I really like is that the way it pulls the answers to my questions and link me to the primary sources. Now, at the same time, what you can see from this article over here, right, is that the websites are basically inclined to allow Google's AI to summarize their page and recommend them as part of the AI answers. Because this AI infrastructure is actually embedded within Google search engine, so this is not two separate tools coming together to perform this task, but basically an upgraded version of Google search engine. And so I think the one thing that concerns a lot of investors, is that with the large investment into AI, like I was mentioning earlier, right, whether or not these companies can adequately monetize their AI platform. And I think, that's where a lot of companies actually get stuck, because, despite the large investment, they're not seeing a very good return on their investments in terms of their AI infrastructure. However, why am I bringing this article up is because if you take a look at their most recent earnings, their CEO, Sundar Pichai, basically told us that, people are asking more complex questions, and they're making use of this AI feature more and more every single day. Now, Philip, who is the VP at Google, also added on that from the monetization aspect, right, the monetization rate of this AI overview is basically approximately at the same rate as before, which already gives them a very strong starting point to continue to find new ways to monetize this part of the business. Now, of course, I think there are some skeptics here who might say that, if without AI, I'm monetizing at this rate, AI is also allowing you to monetize at the same rate, then it's basically not doing anything for your business. It's a waste of money. I think that's one perspective that people can have. But I think you have to understand that perhaps where we are at the AI cycle, the implementation of AI is still fairly nascent in all this industry. And so this is a starting point. So in the past, where they have gotten to in terms of their monetization rate is after optimizing the search engine for so many years. And now, while integrating AI, they're already, starting where they have ended from their previous search engine optimization. And now as they optimize their AI, I do think that hopefully we can actually see a larger rate of monetization after they have integrated their AI fully into their search engine. And so when it comes to valuation, I'm not actually a very big fan of saying, because the market tends to trade at a 15 to 20 times PE, anything above 20 times PE is actually very expensive, right? I know some people tend to do that. But I personally feel that that's too simplistic way of thinking. And how I see this is that investors have to understand that when we do certain valuation models and things like that, sentiment and subjectivity does come into the picture, and that is something that we have to accept, and something that we have to at least check ourselves, at least understand that that is going to be built into our valuation models. So you imagine two shops side by side. One is a coffee shop and one is a 3-star Michelin restaurant. Now, the food at the coffee shop perhaps costs you about $10 per person, and the food at the Michelin star restaurant perhaps costs you $100 per person. Now, someone looking at these two restaurants on the same street would basically tell you that the price of the meal in this location on average is perhaps $55, right? 100 plus $10 you divide by 2, that's $55. Now, does that suddenly make the food from the coffee shop cheap and the food from the Michelin star restaurant expensive? What do you think? Let me know down in the comments below. But to me, that is a trick question, because you don't actually have enough information to make that decision. You see, if the food at the coffee shop costs $10 per person, but I can just cross the road to another coffee shop or another cafe selling a similar quality of food basically for $5 per plate, then suddenly my $10 seem very expensive. However, if other Michelin star restaurants across the street behind me and things like that charge perhaps $150 to $200 per meal, then suddenly the $100 meal seem a lot more palatable. So in Google's case, basically what I'll be doing is to actually compare them with similar companies that people deem as their competitors, and to actually see, how they are valued in comparison to all these other companies. So if you take a look over here, they are currently trading at around 22 times PE compared to companies like Microsoft and Apple, which are trading at over 30 times price to earnings, and Amazon and Netflix, which are over 40 times PE. But I think it's not enough just to compare, a company's PE with other companies in the sector, because you have to go even further. You can't just say that, because people are doing this, eventually you'll be doing this as well. There must be a basis or a reason why the company's PE is so low. Now, if you look at it on a 5-year basis, just comparing Google's PE, right, you can see that back in 2020, 2021, they were trading at a much higher PE in the 30s. But currently, it's trading, I would say perhaps slightly below average, right? I think I would say that if you draw a line across, the average PE ratio for Google is around 25. Now, Google is, one of these companies that always find itself caught up in some sort of news cycle or some sort of narrative, like I was saying, right? Losing its search dominance, or they're hopping from court case to court case and things like that. And, a lot of this fear-mongering and a lot of these things that are surrounding Google perhaps is what causes its multiple to be lower than the rest of the other tech companies. And I think with Donald Trump back in office, hopefully, there's less of this kind of investigations into Google and things like that, and he'll just let them operate, and then, we can actually see a higher multiple being applied to this company. But if you just take the earnings per share this quarter of $2.12 and you analyze it, so you basically times 4. Now, even without the PE multiple growing, right, you can take the 22.5 times PE. This stock will still be worth around $190. And if it's trading at around maybe 25 times PE, right, I believe that will make it a $212 stock. And so as you can see, Google is still fairly undervalued on a PE basis. Now, if you look at my own discounted cash flow, which I was doing earlier, now I believe analysts are expecting a recession in 2025, which is why they have actually projected a 11% growth for Google. And so I'm going to use that same number, 11% growth for Google in 2025. Basically, analysts are also expecting revenue to grow at a low to mid-teens range, which is basically what I'm going to model out beyond 2025. So you can see over here, for Google, in terms of their revenue growth, 11% in 2025, 13, 14, and 15%, respectively in 26, 27, and 2028. Now, on a trailing 12 months basis, their cash flow margin has been around 31%. And so as Google continues to ramp up their Google Cloud platform, I believe this can increase even further. And so if you look at my previous model, I was expecting 29% margins this year, going up to 32% margins in 2028. So now basically I'm just shifting it up a little bit, 31% margin this year, going up to 35% margin in 2028. So the increase is still more or less the same, right? And I will just adjust this number as Google continues to scale their Google Cloud platform. And I'm not going to make any extra assumptions surrounding this and say that, it's going to become 40, 45%. All these are basically pure hopium. Now, in terms of CapEx, Google has already told us that, we are still going to be growing CapEx, but perhaps at a slower rate. So as you can see, 10% this year, and then it basically slows down as we go into 2028. Now, you factor in the cash that Google has and their debt that they have as well. On top of that, Google continues to buy back shares. So if they spend around $15 billion this quarter to reduce their share count, you can see that the implied price here should be around $220 lah. So if basically you think these assumptions are acceptable, then Google should be worth $220 today, which makes them around 23% undervalued. So I think to each person's own comfort level, you can either take a 10 to 20% margin of safety. If you feel like because Google is a juggernaut, is a safe company, you do not need such big a margin of safety, then you can just take a 10% margin of safety. But if you're worried about a recession affecting their ads business and things like that, you might want to take a 20% margin of safety. But because Google is already a juggernaut, we cannot value it in the same way that we do other companies that are still in their growth phase. And I talked about one such company that actually fell more than 10% on 2 separate days and still has the potential to double from where it is today. Now, I talk more about that in this video over here, and I'll see you in the next one.